Today on CXOTalk episode 885, we explore the world of global financial exchanges with Chris Isaacson, Chief Operating Officer and Executive Vice President of Cboe Global Markets. We'll discuss real-world examples of market resilience, the strategic balance between institutional and retail investors, the role of technology such as generative AI and ultra-low latency systems, and much more.
Cboe Global Markets is one of the leading derivatives and securities exchanges in the world. We operate 27 markets around the world, including the largest options exchange in the world. We have bellwether products like the SPX and the VIX index that you've likely heard of before. And I'm the Chief Operating Officer, as Michael mentioned, overseeing all of technology operations and risk for Cboe, as well as 4 business lines that we run.
You talk about resilience. Explain that to us. Tell us why that's so important for you.
Our purpose is building trusted markets, and resilience and trust go directly together. Most people don't understand the exchanges because they're kind of behind the front door. Investors usually interact with the market through an application on their phone or an application on the desktop, but don't really think about how the exchange operates. And we match buyers and sellers in a fully electronic way, and they expect that that's just going to work 100% of the time. So resilience is part and parcel with how we operate our exchanges every day. It just has to work all the time, every time. And therefore, we design and engineer our systems so that when things do fail, which any system that's ever been created, there are failure scenarios, you first assume that something can go wrong and you plan for those so that you can fail over very, very quickly and make it seamless to the users so they don't even recognize if a failure has occurred in the system. So when we think about our systems, they need to be fault tolerant in order for them to be resilient for the investors, for the markets, especially during the most volatile times.
This issue of resilience, and let's face it, you have to be up, obviously, right? If you go down, that's very expensive for a lot of people. So when you talk about resilience, is it primarily technology? Are there cultural dimensions behind the scenes? Every time a pager goes off, does everybody in the company sort of jump and say, oh my God, we have to respond instantly? How does that work?
So it's not just the platforms or the systems. It's the people, it's the processes we have in place. It's even the places where we work. We're always thinking about how to build and run resilient teams. And those resilient platforms come from resilient people. So in the process we put in place, demand that we operate in a resilient way. So as we think about it, fail-safe systems, we need to have automatic failures, of course, that is engineered from the start, but also people, we have very rigorous incident management protocols, we have very rigorous change management protocols we run through, and we run consistent testing of all of the backup systems, both in our primary sites and our secondary sites, and on weekends. There's really consistent testing through many, many, many different layers that are really engineered and run by people, and then bolstered by processes that serve the people and the platforms to make us resilient. So resilient people build resilient platforms using resilient processes. So that's the way we think about it holistically. And it's a mindset as much as it is a technology platform.
And you're Chief Operating Officer, which means that you are ultimately responsible for these operations. Can you describe the kind of behind the scenes demands that this places, both on the technology as well as on the people? And again, how you kind of think about this, how you manage this, and is it the same or is it different from managing a business where there's less real-time pressure?
It is different than managing maybe a business where there's not mission-critical systems. We consider these mission-critical, systematically important infrastructure that we're operating around the world in different countries. So it does require a different level of intensity and intentionality. And it forces you to have very, very good communication, both electronically and person to person, to make sure that everyone is in the loop immediately when any issue comes up, because things will go wrong. And when they go wrong, to ensure that you have very rigorous playbooks that you can follow, and you can systematically and consistently follow them to solve whatever problem might come up. It's a very fast-paced environment because in the markets, seconds and nanoseconds count. And so whenever anything comes up, we want to address it immediately and in a way that's as seamless to customers as possible. So that's actually part of the fun of running markets is markets and technology are very, very dynamic. And over the last 20 to 30 years, you've seen the electronification of markets from trading pits to really fully electronic. We still have one trading pit that's quite active, but the rest of our 26 markets are fully electronic, and therefore they're operating at the speed of light. And when something goes wrong, it can go wrong very quickly, and therefore we are very quick in our response and the communications. It also requires a level of monitoring around the system and observability around each one of our exchanges, each one of our platforms, that we have it instrumented in a way that we can see not just the front door, but every aspect of that system. And the alerting is so dynamic and so pointed that it can highlight the exact issue that might be going on that we need to address in a very precise way at the point of issue.
Tell us about the training that you do of these folks, because the folks that are doing this monitoring, I have to assume, are very, very experienced and have that intuition of how to respond in case of whatever type of blip issue that may arise.
We operate 27 markets around the globe, and the way in which we train our associates is based on a globally consistent platform. So we operate a platform called Cboe Titanium, which runs all of our equities, options, and futures markets around the world. And I mention that because when you're training great associates, great colleagues, it increases the ability to train them in a consistent way on a consistent platform, so that somebody sitting in Sydney, Australia, or Chicago, or New York, or London, they're looking at a very, very similar platform that is globally consistent but locally optimized to the nuances of that country or region or market. So we can train them on the common aspects of a global platform, and then they can learn the nuances of their specific market. And that allows us to have a follow the sun model where somebody out of region, but when the sun is up for them, but not for us in the US, they can know the market, know the technology, and respond very quickly in an appropriate way. And we've invested a lot over the last 3 to 4 years in making sure that we just don't have somebody at the end of the line, but somebody who really knows what they're doing in an immediate way if something were to come up.
And I assume that all of this falls into that category of resilience that you were talking about earlier.
Absolutely. It's all part of resilient people building resilient platforms using resilient processes. I think, Michael, I grew up on a farm in Nebraska, and a little personal anecdote here. I was thinking about where did the resilience come from? And, I saw my parents go through ups and downs, and, it's a very cyclical business that they're in. And invariably on the farm, things would go wrong, things would break. And then I also thought about, I was a decathlete in college, and you run 10 events over 2 days, and you have to think about, okay, did the last event go well? It doesn't really matter. I have to get to the next event, and I have to be resilient through that next event and be focused and keep calm and carry on in the moment. So we try to hire people that are really humble, hungry, and smart, and are willing to really stay cool and calm during crazy times in the market.
I want to make sure everybody knows that you can ask questions. If you're watching on Twitter, X, use the hashtag CXOTalk. If you're watching on LinkedIn, just pop your question into the chat. And we have some questions that are coming in, but Chris, just tell us about volatility and how you respond to market volatility.
It's a very broad and expansive topic. Cboe, we actually created the VIX index decades ago. So if you look on, if you're watching financial news, you'll see the VIX, and you'll see it across Bloomberg and other tickers you might see. So we've measured volatility, created an index for it, and trade futures products on the VIX index. So there's a whole volatility ecosystem of product and trading around it. But your question is around how do we handle volatility and volatile times in the market? And I just want to mention even recent history. So of course in April there was a lot of tariff war talk. There was Liberation Day. There was an incredible amount of volatility that occurred at the beginning of April. And you don't prepare for volatility during volatility. You prepare for market volatility and the stresses that will come to your exchanges and platforms in the quiet times, well before it arrives. So that goes into the engineering discipline we have. We're always building our systems to handle at least 2x what we've ever seen on the largest day. And then on a more micro level, we handle multiples of that on a second time frame or a minute time frame, so that you're ready when the market bursts very episodically. The way the markets work is that there's a lot of times where it's low volatility, and the messaging is roughly directly related. The messages we must handle, orders and quotes and trades, they're roughly directly related to how volatile the market is. So times of extreme volatility when the VIX goes above 50 or 60 or 70 or even 80 during COVID, you would see extreme messaging traffic as firms, customers, investors are trying to manage their risk. And so you must be prepared before. And that's where we're testing on a very regular basis at multiples of what we've ever seen. And I'm extremely grateful to the team that I get to lead. Everything we do here is a team. There's no single person who does it all. And because of all their great preparation, in April, we were able to handle things without issue. Because we'd prepared for months and really years of engineering discipline in advance to handle on a single day in April, for instance, we handled more than 1 trillion messages without issue. And it's very rare to be in a business where you can talk in trillions of messages managed in a day. And very grateful for the team that we made it through, as did, frankly, the market ecosystem, other exchanges, clearing houses. While there was great volatility, the market infrastructure handled it well.
Subscribe to the CXOTalk newsletter. Go to CXOTalk.com. You're part of our community, and we want you back. To what extent do you see your role as being at least partially responsible for maintaining market stability during periods of extreme volatility?
I view my role as COO of an exchange operator and really overseeing exchanges to be a steward of the markets, to operate fair and orderly markets as much as it depends on us. Now we don't trade. Our customers, who are broker dealers, they trade. They're the ones who put in the orders, the bids and offers, and so they determine the price. Our job is to steward the markets, to create fair and equal access, and then to operate fair and orderly markets, and to put trading mechanisms in place and safeguards in place so that if prices get dislocated, they don't get dislocated for very long or too far. So, in my history in the markets, which is now 20 plus years long, I've been through a lot of different points of crisis and volatility, from the great financial crisis to the flash crash to COVID to recent tariff wars. And each time the collective market, not just Cboe, we learn lessons and then we apply those. So for instance, the flash crash, which occurred in 2010 in the US, really had to do with how electronified the markets had become, but there weren't quite enough safeguards in place to avoid runaway prices going too high or too low. And so after that limit up, limit down was implemented in the U.S. equities market, and that has been incredibly effective since then in avoiding stock prices in the U.S. going awry beyond certain trading limits. And it was an idea, frankly, that was borrowed and copied from the futures market, this limit up, limit down. That's just one example of good trading risk management measurements that have been taken and improvements. Also, market-wide circuit breakers have been put in place so that if the S&P 500 goes down a certain amount, I believe it's 7, 13, or 20%, the markets will take a pause overall and not keep trading to give people a chance to catch their breath and then come back with a more cool head, and then the market can decide what the right price is. So it's been rewarding to be part of those changes in the market, because I view our role as a steward of the market to create fair and orderly markets for the good of investors.
So you are creating the context or the container, if you will, within which the markets can operate. And your job, as you're describing it, is to make sure that that context, that environment is fair, balanced, and works no matter what. Is that an accurate way to put it?
I think you're spot on, Michael. That's exactly right. We need to create a fair and equal playing field for all investors and trading participants to operate and to come and trade. So, the rules need to be very fair and open and transparent, and the playing field needs to be level. And so we take that with incredible seriousness.
We've got two questions. The first two questions are very similar, relating to generative AI, with a little bit of a twist in each case. So let me take the first one. This is from Anthony Scriffignano, who is the former chief data scientist of Dun & Bradstreet. He's been a guest on CXOTalk and now does all kinds of interesting things that he's not allowed to talk about. And so I know well enough not to even ask. And Anthony says this: particularly in times of disruption and geopolitical volatility, small perturbations can cause significant short-term market effects. Please share your thoughts on the need to detect Gen AI introducing disinformation, allowing malefactors to capture short-term gains.
The use of generative AI in financial markets is not new, and I think our customers, we don't have full visibility into how they're using generative AI to then inform and to inform their trading decisions or investment decisions. We're using generative AI to help as a productivity multiplier primarily. We've formed an AI Center of Excellence and have 1,200 of our associates that have been trained. As I think about answering your direct question, how do we avoid small changes coming from Gen AI having an outsized impact on the market? I think it goes back actually to those maybe less interesting but very important risk controls that we have in place. Regardless of how the order was generated or how the order was informed, the risk controls are really important to make sure that if an algorithm goes amok because of generative AI, the risk controls are going to stop it from going too far awry. And we've seen those risk controls that have been added over and over and over that have stopped bad things from happening, where you might have an algorithm or whatever cause an issue in the market. So that's not maybe as sexy or whatever as you would expect to hear from an answer, but I think it's the truth, is that good risk controls like limit up, limit down, like drill through protection, like market-wide circuit breakers, etc., help prevent runaway algorithms from having an outsized impact on the market.
Let's go to LinkedIn now, and this question is very similar, and it's from Preeti Narayan, and she says, given the rapid rise of generative AI and trading strategies, how is Cboe preparing to manage the risk of herd behavior where multiple market participants may act on similar AI-generated signals?
preventing that is probably impossible. We can see the effect of it if there is herd behavior, and the effect of it would be that price movements are outsized for whatever the triggers in the market might be. And that goes back to how are the risk controls within the trading firms set, which really all trading firms have chief risk officers, that this is their day-to-day work, thinking about what orders go out the door to the exchange. So there's multiple layers of controls. And then within the exchange, there's risk controls as well to say how much of a price movement is allowed before the order is rejected that might be generated by AI. And then if for some reason orders get out there that become clearly erroneous or are obvious errors, there's actually rules in securities law in the U.S. and elsewhere that define what is an erroneous trade. And it's called obvious error in options or clearly erroneous in U.S. equities. And those are very well-defined criteria. And so that those trades are adjusted or they're actually taken down as error trades in unique situations. So multiple layers of controls in order to preserve fair and orderly markets.
So essentially, as you said, you are focused on the activity. You don't worry about the intentionality, what's in the mind of the trader, but you are looking at the actual trade that's made. And then you have systems to evaluate those trades, the risk and so forth, as you were just describing.
That's right. We look at the effect rather than understanding the exact intent or the origination of the order is sometimes not clear to us. I will mention as an exchange operator, we also have an obligation, and to take it very seriously, to do regulation on our exchanges. So we do market surveillance of all of our markets, looking for any manipulative behavior or behavior that might be out of order. And there are well-worn patterns of what manipulative trading behavior looks like. And then, our independent regulatory department with their separate staff look at that, and they follow up with trading participants if they see anything that does not look like it's fair, orderly, or with wrong intent. So that's a key part of the way that the exchange industry has been created. That was part of securities law put in place, at least in the U.S. in the 1930s. And I think it's good regulation that exchanges have market supervision or market regulatory departments that look after the fair and orderly markets from a manipulation perspective to ensure there is none going on. And that's independent of our trading platforms and systems. The data flows into the regulatory system, but that's done by separate people that are really focused on making sure that there's no manipulation whatsoever.
How do you divide the regulatory or the evaluation function between the exchange versus external regulators? And really quickly, please, because there's so many questions stacking up now.
We take that responsibility on in different jurisdictions. There's different stories. In some countries, the prudential regulator will do a lot of the surveillance. In other countries, we do a lot of the surveillance on each market. And then there's shared surveillance sometimes, depending on the market. So it varies by country and by region, but one way or another, it's covered either by us, the exchange, or by the prudential regulator.
On Twitter, X, we have a question from Chris Peterson. This is more on the technology side. He's wondering if, number one, you've seen an evolution in trading speeds over time, or it's been big step changes. And number two, do you see any floor where trades just can't get faster with current technology?
There have been a constant evolution of trading performance and speeds, latencies going down, throughputs going up, et cetera, with data rates going, very, very large, and always increasing. But then there's been a few times where there's been step functions in performance. So 20 plus years ago when I started in the industry, it was a few tens of milliseconds mattered, and that was kind of state of the art. And now it's single digit or tens of nanoseconds is really what matters to people. So that's been a constant evolution. But there's been times when technology has had a step function forward with the introduction of field programmable gate arrays, so FPGAs that most trading, highly sophisticated trading firms use. I think that really had a step function in how fast our customers can respond to our market data to enter orders. And also, I think the different vendors we use, network equipment vendors, server vendors, switch vendors, etc., they've made step functions at certain times that allow for much more deterministic and fast delivery of market data or inbound messaging. So it's been a constant evolution, and it's been actually really fun to be part of. And your second question, I think, was how is there a limit to how fast things can go? And the real answer is yes, of course, because the speed of light is the speed of light. And are we approaching that? I would say yes, but there will always be an incentive to get faster. It will just be the marginal improvement or reward from being faster, I think, will decrease over time. But what we've seen is just, as I said, the time scales have gone from milliseconds or seconds down to nanoseconds. But those nanoseconds matter enough that trading participants will continue to invest very heavily to ensure they can respond. And, and I think other people might have different opinions about whether or not fast markets are good or not. But the fact of the matter is fast, efficient markets create good competitive prices for investors. So on the whole, I think this evolution has been great for investors.
Elizabeth Shaw has an add-on question to this, and she says, when is speed not your friend?
Speed can not be your friend if the market's moving super fast, and if you're not trading, if you're investing, I think speed doesn't necessarily matter that much to you. If your time horizon is days or weeks or years, which frankly I'll tell you I'm I'm an investor, not a trader, then speed doesn't really matter as long as I can log into whatever app I might have and with whatever broker, and I can get a fill whenever I need it within a few seconds. So I'd say that in that way it doesn't really matter. It may not be my friend, but it doesn't matter as much. If I'm a trading participant where my time scale is very, very tight, then I think it can be your friend or your enemy, depending on whether or not the trading participant has invested enough in their technology infrastructure to be competitive.
Let's grab another question here, and this is from Twitter from Tishiana Johnson, who says, you talked a lot about resilient people. What is something you have found helpful when leading during turbulent times? And I'm going to add not just turbulent times, but what have you found helpful in leading when the market is melting down?
For people that are not familiar with the markets, to kind of be overcome by the moment when it's very volatile and things can be moving very fast. But I've had the great pleasure of working with incredible people for 20 plus years in the market. Many of the people I work with today, I've worked with for more than a decade. And they've learned to keep their calm and think very clearly during times of stress when the market is going quite crazy. And that calmness, to keep calm and carry on, I think is absolutely vital. I think it's vital if you're investing, if you're trading, but also if you're running exchange platforms. You need to keep your head, keep composure, keep poise to make clear, quick, concise decisions that are in the best interests of the markets and investors. And I've seen the team that I get to work with do that consistently, always thinking about what's the best for the market and on what time frame do we need to make this. And you need to prioritize the things that have to be done immediately and do it with excellence.
Sounds like the airline pilot model. Have you ever heard airline pilots that their talk during times where there's some problem going on. It's air traffic controllers. It's extraordinary the level of calm rationality that they have as literally their world is potentially ending.
Yes, I think that's a great analogy, a great example. Clearly the stakes are higher there because people's lives are at risk. Here, people's lives are thankfully not at risk in the markets, but it's very important because people's livelihoods and their financial well-being is. And so we take that seriously, and we need to make great decisions with a clear minds and not be ruled by emotions or hysteria.
On Twitter, X again, Craig Dorchester says, speaking on market volatility, he's heard a lot about 24/5 trading. How does Cboe view the practicality of moving to it? And are there any hurdles you'd anticipate with this shift? And I'm also curious about not just 24/5, but 24/7, because we've all been in situations where we see trading happening outside of normal hours, and us investors are like, twiddling our thumbs as either the market is shooting up or the market is tanking, and we can't do anything about it.
24/5 and 24/5 trading is here and the markets that don't already offer it is going to come even more. So Cboe, we already offer 24/5 trading or nearly 24/5 trading in our futures market, so VIX futures and other futures products, as well as SPX and VIX options, as well as our FX markets, all trade 24/5 today or nearly 24/5. Now, I think your question may be more specifically about the equity markets or more specifically about the U.S. equities markets, that today on exchange, we're really open. We are open from 4 a.m. to 8 p.m. Eastern. And there's a lot of industry chatter and good discussion about making that 24/5. And we at Cboe will be ready for 24/5 trading as soon as, I'll say, the industry plumbing is ready, which includes the consolidated tapes, as well as the DTCC, which is where all trades are cleared in U.S. equities. So as soon as the industry infrastructure is ready, we will be ready to offer that. I think it's good. You can trade off exchange 24/5 today, but I think investors really want a more stable, transparent way to trade between those hours that aren't covered today, which would just be 8 p.m. Eastern to 4 a.m. Eastern, that 8-hour window which we plan to close. We have the technical capability to do it, but the industry needs to be ready because there's a lot of industry processes that depend upon some sort of change window, the trading day rollover, cash movements, margin movements. There's a lot of stuff that goes on overnight, for instance, in the U.S. or whatever overnight might mean in that country, that need to be re-engineered to make sure that trading can be seamless, because we want the investor experience to be good. When they sell, we want them to get their cash when that trade settles. And when they buy, we want to make sure they get the security in their account, and all that back office stuff needs to be worked through very clearly. Now, 24/7, Mike, I want to answer that question. Clearly, digital assets have been trading 24/7 for years now, and we actually have a clearing system, Cboe Clear US, that can clear transactions 24/7, and so that's where I eventually think a lot of asset classes will go. But what doesn't happen on the weekend is, right now at least, you have Fedwire windows and banks, the banking system, traditional finance, a lot of that is closed on the weekend. So are you going to have a huge margin call on Friday to make sure there's enough capital in a clearinghouse to trade over the weekend and handle any volatility that might happen over the weekend? I think there's probably a place for stable coins or things like, or tokenized assets to play in truly getting to an efficient 24/7 market. But in this way, I think digital assets are probably leading, and we'll probably get there over time with more standard equities.
Very interesting, the influence of digital assets, digital cryptocurrencies on existing markets. It's a kind of a fascinating connection, I think.
Yeah, it is. I think there's a lot to be learned both ways, and you see now the kind of what is the proper and good connection of traditional finance with digital assets or decentralized finance, and a bit more clarity coming to what is a digital asset and how should it be regulated. So we welcome the greater clarity, so that under proper regulation, all assets that customers really want to trade and invest in can be done in a seamless and consistent way.
Folks, now would be a very good time to subscribe to the CXOTalk newsletter so we can keep you up to date on shows that we have coming up. You're part of our community. You guys are awesome, and we love your questions. So go to CXOTalk.com right now and sign up for our newsletter. And that way you can join us every time we do this. It's really fun. Okay, let's go to another question. I'm just taking these in order. And on Twitter, X, Tishiana Johnson comes back and she says, how do you manage and build culture among teams that are spread out across multiple countries and time zones?
Because for me, one of my passions is leadership development. I help executives sponsor the Cboe Lead the Way with our head of HR here at Cboe, and I'm really passionate about building leaders, because as leaders get better, then everybody gets better, and the culture gets better. From the very beginning of my career, I've read a bunch of leadership books and whatnot. I think it's a discipline. Leadership is a discipline that people can get better at, and so leaders set culture. And here at Cboe and across my career, I've really wanted to work with people that are humble, hungry, and smart. That comes from a book. Patrick Lencioni wrote a book called The Ideal Team Player, and I just really enjoy reading his books amongst others, and tried to live those values here at Cboe, amongst other values about being better together. And so if you find people that are humble, hungry, and smart, that live our values and are competent, then they can connect in a distributed fashion around the world. In-person collaboration is also very important. So we fly around the world a fair amount in order to have those really critical in-person connections, especially to do intensive training in different regions, so they can learn that common platform, but then be able to execute when the time comes. So it's a continual investment to build culture. I think culture is as or more important than strategy. And even though this is a highly technology-driven business, I believe it starts and ends with people. I care deeply for people, and I want people to be led by great leaders doing great things that are humble, hungry, and smart.
This is from Anthony Scriffignano comes back, and he says, your decathlete background is perfect for your role. It's definitely not a sprint. Crisis and volatility also demand the ability to pivot immediately. What skills do you rely on to get others to move with you quickly, but thoughtfully during uncertainty that demands action?
I think this is built with experience. So you have folks that work with folks that have been in the markets for decades that have learned you have to be agile in the way you think, because the market is new every day. No market is the same as it was, an hour ago or a day ago or a year ago. So they need to be agile in their thinking. And then as we hire young people out of school, out of college, they learn how to deal with the dynamism of the market and to respect humbly that this is going to be a different situation. We're never going to see two situations that are exactly the same. And with that humility, you say, okay, we're just going to learn. We're going to apply what we've learned from past experience, and then we're going to modify it as need be to deal with whatever might come in new market conditions. So that's what I'd say from how to handle new dynamic situations.
Andy on Twitter X says, it sounds like you have a tough job as there's been so much volatility in the markets lately, putting additional stress on financial market systems. What do you enjoy most about your role, and what do you enjoy the least?
Most dealing with really, really smart, humble, hungry, smart people that are they're just super dedicated and committed to building trusted markets. They believe in our purpose, and they believe in what we're doing, that it helps. Building trusted markets helps people eventually, and ultimately invest their capital, and it's about their financial well-being. So I think that's by far the best part, is working with great people. It can be stressful, but being a former athlete, I kind of like the intensity that comes with the market. So at times it can be a bit much in the most stressful of times, but I do really like an intense work environment. I think it's a very competitive work environment. And one of our guiding principles is competitive team spirit, so we can match the intensity of the markets together.
I love the questions that come in, and I always try to prioritize questions from the audience over my questions. And this is now from Arsalan Khan, who has an interesting question. He said, what processes should be abolished to make things more efficient? And he also wants to know the role of data in all of this.
The markets need to continue to evolve to make things more efficient. And you've seen in the last couple of years, there's been a settlement cycle in the U.S. and other countries that's taken 2, maybe 3 days, and that's been the standard practice for decades, many decades, for trading, for settlement of trades to happen. That's now gone to T+1, so on a T+1 basis. I do think there's a lot of disruption and re-engineering to be done on the post-trade side to ensure that there's even more timely settlement, clearing and settlement of transactions that will allow for easier movement and access to capital in a very capital efficient way around the world. So I'd look for more kind of disruption and re-engineering there. And Michael, can you remind me of the second question that this caller?
Arsalan is asking about the role of data, and I'm sure that's a big, important topic, obviously.
Yeah, you can imagine, Arsalan, with at least a trillion messages in a day, we have an enormous amount of data that's growing within our enterprise, and it's highly sensitive, confidential data from our trading participants. But we've built a unified data platform where we put all the data that comes from our exchanges around the world into this platform. It happens to be running Snowflake on AWS on the cloud, and then we're giving access to our data analysts, our data engineering team, and creating insights from that we can use to inform our discussions with trading participants about how they might trade better, to inform them, maybe to educate them of what we're seeing that they may not see yet. And also we're using that data to then provide insights to them in saleable products, like timestamping services and other market data products that give them insights into how they might trade better on our exchanges. So yeah, data is incredibly important to us and to our customers. In many ways, data is the fuel of the markets. And the sale of data or the use of data is a precursor to people trading on our markets and in our products. So we definitely want to get our data closer to customers in the formats they can use.
Derivatives like options and futures can lead to tremendous gains and losses very quickly. How do you, and you kind of touched on this, but how do you manage risks to Cboe, your platforms, partners, and customers from derivatives trading that goes wrong, that goes awry?
I might actually disagree with you on this point, in that I think derivatives, while any asset can be misused, but derivatives really were created to manage risk and reduce risk if used correctly. So we're very intent on education of investors, both retail and institutional, in the proper use of options, for instance. I mean, Cboe created the listed options industry in 1973, 52 years ago. And the Options Institute was created about 40 years ago by Cboe because we're passionate about education, because derivatives, especially options, they're actually there to reduce risk, enhance income, and cap your risk while changing your return profile. The goal is that you can actually increase your risk-adjusted returns without increasing your risk. So I'll give an example of that is, one of the things that's been talked about in the news is 0 days to expiry options that have really taken off in the last few years, and retail investors have used heavily. The level of sophistication of those retail investors has come along, and what we found is that 90% of those trades have capped risk, either through simply capped at the cost of the premium, or they're complex trades that are multi-leg, so they've capped their offset. So we think that's a really healthy indication of the ecosystem, that if derivatives used correctly, they reduce risk. And then for those, very rare situations where people are misusing, we have all sorts of controls in place, risk controls in place, to cap them or to reject their orders, as do the brokerages themselves and the trading systems that they offer their customers.
You used the phrase "used properly," and I think we all know examples of retail investors who were told by their broker, buy these options, and they didn't. The investor relied on the broker, didn't have an understanding of these complex trades, and therefore lost very significant amounts of money. To what extent or what role does Cboe play in helping ensure that that kind of thing doesn't happen?
That's where the Options Institute comes in. Our customers are the broker-dealers, or the retail brokerage platforms, broker-dealers around the world that connect directly to our exchanges. And they themselves have pretty substantial education programs that then we seek to help augment with the Options Institute and investor education. And education is never done, and it's never uniform across every single last investor. I will say there's good regulation and controls in place too around know your customer and the level of education or sophistication you must have before you can get an options account. For instance, when you sign up for a brokerage account, usually what happens is you can only trade equities or stocks before you would get anything on margin. Then before you would be able to trade options, before you'd be able to trade futures, and you have to progress in your maturity and sophistication. I think that's good practice. And so again, education, sophistication, it's not uniform, but there are a lot of controls in place.
And this is again from Andy, who says she or he is a retail trader and Cboe's SPX options. What are your views on the growth of retail trading in general? Anything Cboe is doing to expand market access and products? And I'll just ask more broadly of how do you balance the needs of institutional versus retail investors, including maintaining the fairness that you've spoken about?
It leans directly into some multi-decade trends, secular trends we've seen. So the growth of the retail investor is one of those major trends. The retail investor, at least in the U.S., has been growing in importance and number since the late 90s at least, with the electronification of markets and the enablement of technology. So growth of retail investors is one. Something that's very connected to that, interconnected with that, is the growth of options. And then finally, the desire of access to the U.S. markets, which are still the leading financial markets in the world as far as size and access to liquidity. So those three all speak to the retail investor. And we view that as a very positive development, in that, look back 20 or 30 years ago, a lot of the products, services, systems that were available to institutional investors, sophisticated tooling, sophisticated risk controls, they were only available to institutions. Now they're really at the fingertips of the retail investor. As I mentioned previously, that retail investor is much more sophisticated because of those tools, because of that education. So we're very excited about that, and we're here to serve the needs of all types of investors. They have different needs, they have different profiles, and we want to offer them products and markets that can satisfy them all.
And we have a question from Chris Peterson. Cboe runs many markets. Are there any moves towards mixing asset classes, for example, crypto plus legacy, within markets, or markets merging / breaking national or regional boundaries, and more or fewer markets over time? And obviously, your view towards the future of where this is all headed.
There are examples where we have cross-asset order types, for instance, where you have an options trade with a futures leg or an options trade with an equity leg, a cash equity leg today, certain order types. I think we'll see more of that within each country or region over time to the extent it doesn't already exist. Connecting markets globally across jurisdiction, I think is more difficult potentially outside of digital assets. That's more difficult because of the regulatory structures and jurisdictions that are in place. So more cross-asset, maybe more cross-geography, but that will take coordination amongst, government authorities or regulators within those countries.
Any thoughts on where digital assets, cryptocurrencies are going?
They've become more mainstream, as you've seen in the last year or two. Assets under management will continue to grow. I would mention a couple things. The introduction of crypto ETFs, of which Cboe listed 6 of the first 11 in January of 2024, I think was a milestone moment in digital assets where people that normally just invest in equities then would have access to digital assets through the ETF wrapper. I think that's opened up a whole new level of users. We have indices on digital assets. I think there'll be more and more indices, more and more access to digital assets, at least for the top few names or digital assets out there.
Any final thoughts on what we investors and technologists and people listening really need to know about exchanges like Cboe that we probably don't know because it's hidden behind the scenes?
Building trusted markets is a passion for us. And as an investor, retail investors, I would mention that because it's a passion for us, which I think ends in a good result for investors, institutional and retail alike. If I look back to when I started in this industry in the early 2000s and the access that investors had to different tradable products and how long it took for them to trade, that took quite a while, and it would be measured in seconds, sometimes minutes, and the commissions were very, very high. If you look at how things have changed over time, you have near immediate access to almost any asset you want to trade or invest in at an incredibly low cost with very low friction, which I think is incredible in this industry that retail investors have the tools and sophistication at their fingertips like institutional investors do from 20 or 25 years ago.
On that topic, Arsalan Khan has jumped in with a last question that's a really interesting one. He says, do we need humans when AI can do options? But let me turn that question around and say, should we people be relying on our judgment when we can use machines, data, and AI to make trading decisions that can analyze more data faster than we ever possibly could?
Humans will always be needed, and humans will need to be in the loop, at least during different time frames, at least in the developing of those strategies. Over time, of course, markets will continue to evolve and strategies will evolve, and the level of human involvement will vary based on the strategy. But I think humans will always be needed, but humans will need to embrace AI in order to harness it and use it for our benefit.
Fair enough. And with that, we're out of time. A huge thank you to Chris Isaacson, Chief Operating Officer and Executive Vice President of Cboe Global Markets. Chris, thank you so much for being here with us. I'm very grateful to you.
Well, thank you, Michael, and thank you all your followers for all the great questions. It's been my pleasure.
Folks, before you go, subscribe to the CXOTalk newsletter. Go to CXOTalk.com. You're part of our community, and we want you back. Thank you guys. You guys are awesome. Such great questions. There's no show next week, but the following week, we're back into it. We have amazing shows coming up, so check it out, and we'll see you again next time. Take care, everybody.